Hello, everybody. Welcome to another episode of the Olympus Wealth Strategies podcast. I'm your host, John Sidery, and I'm very thankful to have a special guest on the podcast with us, Brandon Flickinger. He's with Bridge Investment Group. Brandon can certainly talk about his firm a lot better than I can, but they are a nationally respected real estate firm that does a lot of very interesting investments, and some of you listening out there might be invested in Bridge or certainly have been made aware of them. And so, Brandon, thanks for coming on the podcast and joining us and shedding some light about the real estate sector.
Yeah, John, thanks for having me. Appreciate you and the Olympus team including me on this podcast and looking forward to our conversation.
Well, absolutely. Well, hey, I always like to get to know the person behind the job. So maybe tell us a little bit about yourself and certainly would love to hear a little about the Bridge story as well.
Absolutely. Well, my name is Brandon Flickinger. I'm the Co-Chief Investment Officer of the Net Lease platform at Bridge Investment Group. I'm also a Senior Managing Director at Bridge. On a personal level, I'm first and foremost a dad, have 3 kids, ages 14 to 8. So things are crazy, but the right amount of crazy with sports and family obligations and travel. And it's just a lot to be thankful for. Professionally, as I mentioned, I'm a senior partner at Bridge Investment Group. For those unfamiliar, Bridge is a $50 billion AUM real estate investment management firm. We're a top 15 equity manager for U.S. commercial real estate investment. We currently manage 12 different sector-specific strategies within U.S. commercial real estate investment across 32 different vintage funds. We believe we offer a differentiated approach to U.S. commercial real estate investment through our dedicated sector-specific teams. And this is a timely conversation because it was announced in February that we're being acquired by Apollo Global Management. That transaction is contemplated to close in the third quarter, and upon completion of that transaction, we will be the real estate equity deployment arm for Apollo. So very exciting in all regards.
Extremely exciting, and obviously you're going to add a lot of value to Apollo's existing real estate arm. So, Brandon, maybe tell us a little about the current state of commercial real estate. Obviously, I feel like we've gone through these last few years. It's certainly been a roller coaster in some regards, depending on which sector we're talking about. But maybe describe the current state of the commercial real estate environment and maybe what sectors are showing the most resilience within commercial real estate.
Absolutely. And I think you've keyed upon it really well with this concept of bifurcation and differentiation of sectors. When we kind of look back 2015 through 2021, you had the benefit of a declining rate environment and a low rate environment during that time. The other component of consideration here is that during that time, you saw the primary U.S. commercial real estate investment classes all performing really well. And I'm referring to multifamily, office, retail, hospitality, industrial. They all had strong fundamentals, strong performance. They benefited from the economic growth during that time. And then coming out of the COVID pandemic, really beginning in early 2022, you saw a material change in the sector. We saw a bifurcation of sector performance resulting from changes in the demand drivers for each. On one hand, kind of painting the corners, you have the U.S. office market. And then on the other hand, you have some of the other sectors like industrial and multifamily that still have retained really strong underlying occupier demand and fundamental tailwinds that are driving occupier demand that offer the opportunity for what we believe is long-term capital appreciation through exposure to the sector. And that change occurred during a rising rate environment. So exacerbating the impact at the asset level was the macro environment resulting from rising interest rates. Specifically, this is an asset class broadly defined that relies on leverage to generate a return, and that exacerbates return in a positive respect during when leverage is accretive in a declining rate environment, and then has the opposite effect in a rising rate environment because the impact of leverage becomes deleterious to your overall returns and has an impact on asset values resulting from changes in base rates and the benchmark rates in the U.S. Treasury and the short-term borrowing curves. So you've seen a real bifurcation based on everything that's happened 2021 through the current environment. And then kind of leading to one of your questions, I anticipate, John, is then you have the impact of macroeconomic socioeconomic and governmental policy affecting the sectors in various ways. And so it's become a really transitional period for real estate, but one that we think has some really compelling deployment opportunities depending on who your manager is and where you're invested.
Well, and you'd mentioned one of those sectors being industrial, and obviously, I feel like that's a sector where Bridge shines. So, can you, for the audience, describe, Brandon, just the industrial net lease space as a sector and specialty that you all have a focus in, and then ultimately what makes that sector attractive right now?
I'll back up a little bit. Our conviction in the sector is derived from three things about how we orient ourselves around capital deployment at Bridge. And that's one, there's a housing shortage in the US, and that in a lot of respects guides our multifamily business. We are the, I believe, depending on which metric, third or fifth largest multifamily owner in the US through our multifamily flagship funds. We own approximately 60,000 multifamily units. We are the largest opportunity zone fund manager in the world, and our opportunity zone fund management strategy is contemplated around the provisions in the tax code regarding opportunity zones, but also tied to mixed use development with a multifamily component. And then the other two components, kind of our guiding lights, are the resilience of the U.S. economy and the U.S. as a safe haven for international and domestic investment, and also the growth and resilience over a long period of time of U.S. GDP growth, which is largely overweight to the strength of the U.S. consumer. And that last component really drives our conviction about the U.S. industrial sector. We invest in our net lease platform in industrial warehouse, logistics, manufacturing, and cold storage assets leased on a long-term basis to credit-worthy tenants, with the intention of delivering current income from those properties with the opportunity for long-term capital appreciation through exposure to the sector. The net lease portfolio as it sits today is approximately $850 million of gross asset value of investments that are thematic to the strategy that I just described. Our performance to date has been in the top fifth percentile for our benchmarks and our peer set, and I think it's a really compelling time to have this conversation because this last quarter marks our fourth anniversary since launching the net lease strategy at Bridge. And so we've been able to demonstrate proof of concept in a rising rate environment, but also being an established but newer entrant in the space that's not encumbered by billions of dollars of assets acquired at last cycle pricing. Your question was why industrial? And for us, the underlying occupier demand fundamentals are really compelling, both on a nominal basis. Most of our relative predictive analytics demonstrate that you're going to see high single-digit NOI growth through exposure to the sector for the remainder of the decade. But also on a relative basis, the sector we think is poised for outperformance. And then the fundamental drivers of that are the continued proliferation of e-commerce, the resurgence of U.S. manufacturing and reshoring and onshoring of international manufacturing back to the U.S. And then another theme that we've seen start to take hold for a longer period of time, which is since COVID, you're looking at domestic users of warehouse and logistics space looking to retain control over their supply chains that were disrupted during the COVID pandemic. And the cumulative effect of those demand drivers is that we're continuing to see really strong occupancy growth, low vacancy rates relative to historical levels, and those levels are within the range where we've seen landlords retain pricing power, able to drive rent growth, and again offer the opportunity for exposure to the sector that should offer long-term capital appreciation opportunities.
So, Brendan, would you say for those properties that you just described, a lot of these are viewed as mission critical properties for the particular companies?
They are. And the mission critical adjective, I think, gets used a lot by net lease investment managers. For us at Bridge, mission critical means we are attempting to determine how much EBITDA the business generates under the rooftop of the asset we own. Specifically why they're in that asset and why that asset is critical to their generation of revenues and to the prosecution of their business. We look at the primary protections afforded our investors through the investment process as being our ability to select compelling real estate assets, meaning assets that have a fundamental competitive advantage against other properties in their submarket and their competitive set. So what's differentiated about that asset? And then the other two being our ability to assess counterparty risk in the form of tenant credit assessment. And then the third component that determines our investor outcomes is our financing strategy, with leverage being relatively unaccretive over the last 3 years. We view net lease as a conservative strategy. I flippantly believe that, my investors want to know that their distributions are secure and that they have good visibility on that. And so we've been what I would describe as responsible users of leverage. We're running the portfolio at sub 50% loan to value. But I think equally as important is that we've been fully hedged from an interest rate perspective since we began deploying capital into the fund in 2021 through implementing interest rate hedges on our credit facility. I don't suggest we foresaw what was coming as quickly and dramatically as it came in the form of rising rates, but that hedging strategy was put in place with intentionality to protect our investors against wild swings in interest rates and make sure that their distribution yield is secure. And our net distribution yield inception to date is approximately 7% or is 7%. And so I think that's demonstration of sort of the conservatism through which we view net lease investment.
So, Brandon, you mentioned one thing that was really interesting and compelling is obviously, there's some terms in this industry and there's a lot of jargon, but, mission critical, like you said, is widely used. But Bridge and what you guys do, and you specifically will look at, is how much revenue and EBITDA is actually generated on that particular property.
Correct.
And would you say that's maybe where one of the main focus points you look at, and maybe that's what helps define a potential ideal investment when you start scanning the total horizon of different opportunities?
Absolutely. I think one of the ways we view our approach to net lease investing as offering a value proposition to our investors is our team has been together for approximately 15 years. We were at a public REIT for about a decade before joining Bridge Investment Group in 2021. We felt that a lot of our competitors in net lease were passive capital allocators, and that's really been driven by how responsibilities under a lease are allocated under a net lease strategy, meaning that the tenant typically bears all responsibility for operating expenses and a majority, if not all, of the capital expenditure exposure at an asset. And so we're really driving down into what makes an asset unique within a sector or within a market. And I'll give an example of that. One of our early fund investments was what I'll describe as a pet food manufacturing facility north of Denver, Colorado. We acquired it off market directly from the private equity sponsor who was looking to monetize the real estate of their portfolio company. And this ties into the credit piece. It's an industry that we thought had a lot of thematic tailwinds, in that this business and this asset is critical in producing high-end proteins for pet food. And not to get too into the weeds in that, but through our credit research, we determined that with higher percentage of higher income earners were allocating larger amounts of their discretionary income to procuring higher end quality pet foods for their pets. So think like venison, bison, in some cases alligator, things like that go into a healthier pet food. And this business was growing at a low double-digit rate year over year. And so that was something that we thought was really compelling. And then this asset was their sole manufacturing facility, where the proteins are brought in on frozen pallets and then transferred and frozen and packaged to be distributed to the primary pet food producers in the U.S. And they were looking to encumber the asset on a long-term lease that ran through October of 2036. The asset itself was differentiated from a qualitative perspective because it was in a competitive submarket that had low vacancy, had seen good rent growth year over year, but this asset had low site coverage, so it had excess parking for tractor trailer storage, which made it compelling and an alternative use for other users. And also about a third of the facility was built out as cold storage in a market that was underserved from a cold storage standpoint. And so those qualitative considerations gave us confidence that in a downside scenario, I could release that asset at higher rates than I was recognizing from my existing tenant, while having the quantitative attributes from a credit perspective that we look for. That's a mission critical asset leased to a business that has a well-diversified income statement, is responsibly leveraged, and then we look at the composition of the balance sheet from a debt perspective and stress test the income statement to make sure that those businesses can withstand a meaningful drawdown in top line revenues and still service their fixed charge coverages and pay us rent for a 15-year lease term.
Brandon, I want to go back to one other point you mentioned just about the fund itself, because I think there might be a little disconnect between what investors or potential investors think of industrial real estate investments versus maybe the reality of what you all have been able to do, which is, I get this multiple times, people are associating maybe industrial net lease with lower yields, but also stability. And I would just love to get, obviously, as the chief investment officer, love to get your thoughts on that. And then, how does Bridge go about trying to enhance returns while certainly managing the downside risk?
Sure. The stability component is accurate. This is intended to be a stable income producing asset class. And that's when I'll take a step back and explain how we're administering and governing the fund. So we're investing in single tenant net lease mission critical assets. Our portfolio right now is comprised of approximately 35 investments totaling 5.8 million square feet, geographically diversified, of investments that are thematic to our strategy. We look to obtain and identify assets that are off market. Roughly 70% of our investments to date have been off market. The lower yield strategy, I think a lot of ways is tied to investment grade rated tenants and buildings occupied by investment grade rated tenants. And I'll give an example. For, I think up until a few years ago, the most widely advertised trade in our market was a warehouse leased to Amazon for 10 years in the I-95 corridor, South Florida, New York, New Jersey, or adjacent to a port. Those transactions were largely brokered by the primary real estate brokerage houses. They were competitively bid and traded for historically low yields. We did not see a real value proposition in participating in that process. And what's happened is we've seen a lot of those investors who bought long duration net leased assets, finance them with short-term floating rate debt, and now they've got a broken capital structure that they either need to re-equitize or sell the asset to pay off their loan balance. Those assets are coming back to market at what we think are now attractive yields. And so now we're participating in that process as sort of a rebound investor, because you've still got a performing asset with a broken capital structure. But that really, I think, maybe informs the perception that this was a low yielding asset class. I think the other differentiator in how we participate in net lease versus the low yield concept is a lot of assets that are encumbered by leases to investment grade rated tenants, meaning tenants that have an rating issuer from Moody's or S&P, trade at disproportionate premiums to the market. And again, we don't see a real value proposition there. S&P and Moody's typically issue a rating. That rating is 18 to 24 months in orientation. The weighted average lease term on our portfolio today is 11.4 years as we sit this week. So that should inform kind of how you're thinking about this strategy. So stable, long duration. And we think that those ratings command a premium in the market disproportionate to the overall return proposition. We're seeing fewer companies go to the public markets for ratings, either through the issuance of equity, the issuance of debt, or through an operating company transaction. So a larger universe of private tenants. And just because they're private doesn't mean more risky. It just means that they don't have a rating agency rating. And so we kind of view the investment grade rating space as a value trap. So we look to avoid that unless we feel like we're being disproportionately paid for the cap rate.
Makes sense. And I think one thing to clarify too is if an investor holds, in particularly Bridge, in the Bridge Fund, Industrial Net Lease Fund, in a non-qualified account, that 7% taxable equivalent yield can be much higher.
Correct. We've run some analyses. Our distribution yield on a tax equivalent basis is over 10%. That's obviously subject to each individual's tax treatment and the tax bracket they're in, but it's higher than all of the what I would describe as the income oriented proxies in the space, B REIT, S REIT. That's something we're very proud of. It's I think a demonstration of the totality of the investment process, but also our ability to source assets. And again, we've been the beneficiaries of having aggregated a portfolio largely after we've seen the material decline in real estate values across the board. And so our cap rate is wide of most of the material indices. We think it's demonstrates a fair value proposition to the market. And then the governance is also critical. We're valuing our assets externally with a third party valuation consultant, and that should give investors confidence that within our semi-liquid structure, they're owning a pool of illiquid assets, but encouraging them or giving them comfort that they're trading in and out of that on a monthly basis at a fair representation of market value is something that we think is of critical importance.
Well, absolutely. And to give people peace of mind that it's not just marks that are being made
Correct.
based on maybe how Bridge feels, right? It's certainly
Right.
from a independent source.
Yeah, that is one of the criticisms of the space outside of our fund is that some of the larger managers value their own assets. When we were structuring our vehicle, the investor confidence was a critical consideration. And so our process contemplates an external valuation consultant that values every asset on a rolling basis throughout the year. And in addition to that, we have a third-party appraisal firm that appraises each asset on a rolling basis throughout the year, and that informs our valuation consultants' marks. So two protections in place that should demonstrate best-in-class corporate governance.
I would completely agree with that. We talked about some misconceptions, and those are the ones that I've heard. But Brandon, are there any others that maybe you hear, whether it be in the industrial space or just maybe commercial real estate in general, that you hear from investors and maybe want to provide some clarity on?
Yeah, I'll speak to the what I think is considered a passive investment structure in net lease, and we could not disagree with that more. And what I mean by that is that you see a lot of competitors in net lease as passive capital allocators that don't have an active asset management capability. Specifically, we believe that there are opportunities to generate incremental yield on your portfolio every year by having active asset management staffing and capabilities. And I'll give an example of that. Our first fund investment was made in July of 2021. At the time of investment, it was leased through July of 2031 to a global tier one auto parts manufacturer. That company is domiciled overseas, but we had the U.S. subsidiary as the guarantor under our lease, and our credit diligence determined that entity comprised, roughly half of the global revenues and composition of the balance sheet. We also identified it as mission critical through our credit evaluation process, through what they manufacture at the asset, which is something called a catalyst, which is a component that reduces emissions in Class 8 and heavy duty trucks. It's critical to them, so we've maintained a good relationship with their global corporate real estate team, but also the facilities manager. Our credit thesis was affirmed when the operations of our business were acquired by their largest domestic partner and its clean mobility initiative. As a result of that, we were able to extend the lease for 2 additional years through July of 2033. Equally as important to our investors was that we obtained an investment grade rated parent as the new guarantor under our lease. I think that asset would have traded 50 to 75 basis points lower on a cap rate had that guarantee been in place when we acquired the asset. And then in talking to them about their needs at the asset on a monthly basis, we've determined that their HVAC systems were insufficient for what they wanted to do with the asset long term. That obligation was is a tenant responsibility under the lease. We told them we'll fund that capital expenditure into the asset. In exchange for that, we're going to amortize that back into their lease stream at an accretive rate. And we're in negotiations to extend that lease for an additional 5 years through July of 2038. And so that's an example of maintaining good tenant relations and active asset management, where you can generate incremental yield on a small number of assets in a diversified portfolio on an annual basis. And over time, that really inures to the benefit of our LPs.
Absolutely. We kind of touched on this is in regards to, looking at downside protection within the fund itself, but also an inflation hedge characteristic. And so maybe can you describe just maybe in broad terms the expectation for this asset class in an inflationary environment as we continue to hear headlines of what's the Fed going to do? Are they going to cut rates? Are they going to keep holding them steady? How are the CPI reports printing? Can you maybe just kind of give a broad expectation overview for investors?
Sure. And I think I'll caveat that by saying within a net lease strategy, we're not paid to take meaningful rate risk or make bets on the direction of interest rates. My responsibility to my investors is to protect their income stream, select responsible investments, and make sure that their distributions are secure and steady, current, durable, and growing. Our view at Bridge and soon to be Bridge powered by Apollo is that we are in a higher for longer scenario. That has been our steadfast belief for the better part of 18 to 24 months. That conservatism informs how we leverage our assets at the asset level. It informs how we employ leverage at the fund level, and it also informs our selection of assets and making sure that we're acquiring assets that offer the opportunity for outsized return relative to inflationary expectations, appreciating that it's a volatile time, and this administration has certainly made things interesting in a lot of respects, and it's our job to be party agnostic and making sure that we are deploying our investors' capital as thoughtfully and as responsibly in a differentiated manner as we possibly can.
Well, Brandon, you touched about the administration, and we won't get too political here on the podcast, but given the recent legislation that was signed by this current administration under the Big Beautiful Bill with 100% bonus depreciation coming back, is there any thoughts or expectations from where you sit as far as companies making larger investments, maybe more onshoring, maybe more growth in this particular sector? Is there kind of a thought from this recent legislation being passed?
There are, and I'll kind of share that in segments in which you asked it. First, I'll just refer to the accounting treatment of bonus depreciation. And so into our net lease portfolio, we have two entry points. One is our non-traded REIT 1099 entry point, and the other is our K1 private partnership entry point, which benefits from a full pass-through through investor reporting in the form of a K1. That legacy vehicle will disproportionately benefit from the bonus depreciation and has up to this point. All of our distributions through that entry point have been tax protected, and we've been able to generate some excess passive losses as a result of bonus and accelerated depreciation that our investors love. The NTR, the non-traded REIT, is a 1099 vehicle. It's our expectation that the benefits of bonus depreciation will be marginal in that vehicle, and appreciating it'll vary by REIT, but generally REITs have to pay out 90% of their taxable income to maintain REIT status. And so the benefits of bonus and accelerated depreciation within those vehicles will be significantly less than through a private partnership fund. But transitioning to the bigger question at hand, and that's through the Big Beautiful Bill, but also administration policy on tariffs, the outcomes for industrial logistics real estate should be incredibly positive. Appreciating the sequencing of events is fraught with risk and has resulted in volatility in the equity and debt markets. And kind of as a starting point, the current administration's views through the implementation of tariffs are to increase domestic revenues and obtain what they describe as a more fair and level playing field with our trade partners. The stated long-term goals of tariff policy are to increase U.S. GDP, reduce long-term borrowing costs on the federal deficit, and spur a resurgence of U.S. manufacturing. And we've seen approximately $300 billion of investment announced in manufacturing projects throughout the U.S. since January. It's getting from A to that last point that's, again, fraught with risk. And the sequencing is really interesting and changes, frankly, on a weekly basis, appreciating we're investing in a long-term asset class. And so through the negotiations and through policy statements and frankly, geopolitical, economic, and socioeconomic events, we're seeing a lot of volatility in the markets. But if the administration is successful in achieving the outcomes that they've stated are their long-term objectives, the impact on the U.S. logistics and warehouse market should be incredibly positive. And frankly, we started to see a lot of it take hold prior to this current administration's aggressive stance in 2025. If I look at 2024, if you take all of the net lease or all of the industrial absorption in the U.S., and that's the U.S. industrial market's about a 50 billion square foot market. If you take 13 billion square foot market across the top 50 markets of consequence, those markets have a combined vacancy rate of about 7%, which is higher than it was at peak occupancy during COVID, but still well below historical levels when we've seen landlords retain ability to drive long-term pricing power. Last year, roughly 18% of net absorption was gobbled up by manufacturing users, meaning users who were using industrial facilities to manufacture goods and services. And the expectation is that that's going to increase to approximately 30% by the end of the decade. So a real material sea change in underlying demand driven from U.S. manufacturing. And that's a combination of build-to-suit opportunities for new manufacturing facilities, but also legacy facilities that are being repurposed for modern-day manufacturing. And so you factor that in with the lack of construction lending from banks, we think that the build-to-suit space is a really compelling risk-adjusted return as a private capital provider to developers and users who have a demonstrated need for manufacturing space.
Brandon, when we talk about, certainly where I sit from my seat, we talk about real estate as a part of an overall macro portfolio for a family. How would you say this strategy fits into a diversified portfolio? And maybe just some characteristics, if you wanted to go into details of maybe who it's best suited for, or kind of what role or expectation it should play in an investor's overall portfolio.
Absolutely. And I'm going to tie this somewhat into Apollo's acquisition of Bridge Investment Group. And if you look at the big investment managers, there's this concept that's been described as the democratization of alternatives, or the democratization of alts. And that's that structuring and offering everyday investors more access to private markets, private real estate, private credit, and private equity. And so within a diversified portfolio, this is an income-oriented strategy being net lease. There are lots of flavors of real estate based on sector diversification, return parameters, risk profile, but unanimously, every investment manager believes that private markets should have a larger allocation to an individual investor's portfolio as we migrate away from the legacy 60-40 model, public equities, public fixed income.
Well, especially when you take a look, right, Brandon, at a lot of the pensions and endowments of today's environment, and the NACUBO study that gets published every year, and you see an overwhelming amount of private markets and alternative investments that are in their portfolios, and you can argue that they don't have very many capital constraints, and they have access to the best and brightest minds and investments available. And so I guess if you break that down on a family level, if they qualify for it and they're okay with more limited liquidity, why not implement that same thought for investors?
And agreed. I'm not dodging your question because it's specific to an individual investor, their
Oh,
net
sure.
worth, their return horizon, their risk profile. But it's hard to argue against the concept of diversification unanimously. And the universe of publicly traded or publicly rated companies is actually getting smaller. And so, why disadvantage investors by offering them less exposure or less investment opportunities when the private markets have demonstrated a value proposition over a long period of time? And then that's, the value that Olympus provides to its clients is working with an investor to understand what their goals and objectives are, what's their risk profile, and then determining what's the best portfolio of investment offerings for that investor. And it's where you've seen the big investment managers, Blackstone, Ares, KKR, Apollo, all, and the universe goes well beyond those names, where they're orienting their future growth, and that's down channel capital.
Well, Brandon, I also want to touch upon maybe kind of a forward-looking outlook. You kind of touched on that with recent legislation, but for investors, what do you think they need to be paying attention to over the next maybe 1, 2, 3 years for real estate, or if you wanted to even dive into more particularly the industrial or net lease space?
Yeah, I would tailor it a little bit, my answer, to your evaluation of a fund strategy, of a platform, of an investment team, and you're allocating your capital to a team. Start there by saying I would do a lot of
Well
diligence
said.
on the investment team. What's their track record? What's their experience? How long have they been together? A question that don't get asked frequently enough is how much capital does that team personally have invested in the vehicle to create an alignment with their investors, and not referring to stock options or allocated carry, but how much capital did that team or that individual personally write a check for to be shoulder to shoulder with the investors? Because I think that's a real strong demonstration of alignment of interests. And for us at Bridge, we all have significant personal investments in these funds, and it's that responsibility that both keeps us up at night and gets us up in the morning. So you're seeing more offerings to the market, more private offerings to the market, marketed or oriented towards individual investors. And so as you're trying to make sense of all of that, these are really compelling questions that you should ask. The risk profile varies across the spectrum. I'm stating the obvious there, but it's really understanding what the strategy is, what is the governance of the vehicle, and I'll use an example there. What's the liquidity provision? We invest in an open-ended fund structure with monthly liquidity to our investors, subject to an appropriate gate that's intended to give an appropriate amount of our investors liquidity on a monthly basis, while not disadvantaging the broader investor base by forcing sales when it would be disadvantageous to a majority of our investors. And that's how most investment managers are structuring these vehicles. But these are things that you really need to drill down into the asset level to understand what is the collateral, where is capital being deployed, and what trust but verify through your diligence process. Really dig into the cash flows and where the derivative risk is in these investments to ensure they're appropriate for your clients. I think that what I'm speaking to is really navigating what is becoming a very competitive field for the offering of private investment products.
I would completely agree, and at least from my seat and the team's seat, there's a lot of people that reach out with brand new funds, right? Brand new teams that get put together, but it's going the extra step of looking beyond the fact sheet and really understanding, like you said, how involved is the team, how much alignment of interest is there, and really what's their background and being able to manage not only in good cycles but tough ones as well, and ultimately the quality of assets that they have. And Brandon, obviously, we greatly appreciate you coming on the podcast and Bridge's partnership with us. Is there any kind of final thoughts you want to leave to the audience?
No, we're appreciative of the time, and I'm appreciative of the invitation to be here today. I always tell investors you should be comfortable engaging with your investment managers. We are open here at Bridge. We always ask people to reach out to us directly with questions, concerns. Always happy to walk through the strategy, and I think that openness is really indicative of how the relationship is going to go over a long period of time. So thank you, and good luck to everybody.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.